Greetings from Fin Study Club. My name is Ankur Kulshrestha, welcoming all viewers to a very important but sometimes confusing session on the use of gross value versus the net value of the fixed asset in the context of conversion from the indirect method to the direct method. Now, before looking at this session, I am sure that you have already looked at our previous recordings, wherein first we had talked about the overview and basics of cash flow statement. Then we had talked about the direct method in detail with a very good example. Then we talked about the indirect method, again with lots of examples. And before coming on to this topic, the conversion part, we have already recorded part 1, wherein we have talked about the operational cash flows. Then part 2, where we talked about the financing and investing cash flows. And here we are almost at the third stage. After this, we are going to talk about a very important session again, which is going to be calculation of profit after tax from the balance sheet and additional information in absence of the profit and loss account. So before moving on to what to prefer, it is very important to understand the basics and the difference between the gross value and the net value. Well, something is called as gross value when the original purchase price and the depreciation till date is given separately, so to speak. The communication is better, much better, compared to if only the net book value, which we sometimes called as the written down value, also called as the amortized value, is given. It communicates that the total purchase price is 1000, which has been reduced by 100,000, which has been reduced by 40,000 to make the value today terms is equal to 60. If we just show it as 60, it might give us a sense that it might be 80 minus 20, it can be 70 minus 10, but this way, when the gross values are given, there the information flow is much more effective and better. So as an analyst, you should always thank God whenever the information is given at a gross level. Well, as an execution level, the difference that it's going to make is that do not account for the cash flows at a net level. Try and make both the ledgers separately. By ledger, I mean the gross value and the accumulated depreciation. Try and make two different statements and find out the balancing figure in each of these. Okay, so jumping on to a practical example, I am deliberately mentioning it as example number 5 because we have already done 4 examples in a very detailed fashion up to part 2, which was financing and investing. So here it says that your property, plant and equipment is 100,000, which means the gross value is 100,000 at the beginning, which becomes 120. The accumulated depreciation till date is 45 and 40 respectively, and your therefore your balance net is 60 and 75. In the income statement, there is depreciation value and the loss on sale value. So during the sale, there is an additional information as well given. Says that the machine whose original value, the gross value, was 45 has been sold off for 25. A quick question also given is that the depreciation till date, which means the accumulated depreciation, was 24. Now here the point is the CFA curriculum and different authors try to solve this by help of an equation. I have really no problems with the equation if my students are able to understand the logic of each and every equation and they are able to recreate that in the exam. Many a times it happens is, we get a call saying, sir, what will happen in a particular scenario, to which then I ask a question that, doesn't your equation apply? They say, no, the equation is not applying right now because there is one of the additional variables which was not mentioned in the book. So again, the point is that we got to be very logical in our approach rather than trying to mug the things up. So like I had mentioned at the beginning, we are going to make accounts of property, plant and equipment and the accumulated depreciation separately, noting the changes in each of those. So let us try and make property, plant and equipment first. Point to be noted, this is mentioned at the gross value. So there was an overall plus 100,000 and there is the closing balance of 120, both at the gross value without depreciation. There has been some asset sale which is of 45. Again, the point to be noted, this value is also gross because that's how we will be able to create apple to apple, and the balancing figure on this side is 65,000, which is the machinery purchased. So I've been able to find out the balancing figure from the property, plant and equipment, which is the purchase of machinery. So I'm just writing here purchase, which means cash goes down by 65,000. Let us try and make another account which is of accumulated depreciation. Fairly simple, just be a little patient. My opening accumulated depreciation is 40,000. It becomes equal to 45. During the year, there has been some asset sale on which the depreciation charge till date was 24. So this 40,000 is corresponding to this 100,000, and therefore the amount which is corresponding to this 45 also needs to be removed from the bucket so as to make it the total amount as 69, telling me that there must be a fresh inflow, the depreciation during the year worth rupees 29,000 which must be charged, which is reconciled from here. Hence that tells me that my answer is correct. So here the depreciation, as you will see, is a non-cash expense. They will not give me any additional information as far as my cash flow is concerned. Nonetheless, it is very imperative to make this account to find out any balancing figure which might have some kind of a relevance for the property, plant and equipment. So overall, if I were to summarize, there has been a purchase of 65, there has been a sale of 25. Point to be noted is the net figure of 21. Now you would understand that historical cost is 45 and accumulated depreciation was 24. So on the date of sale, the written down value or the amortized cost was 21. Selling the asset for 25 will give me a gain of 4,000, which is exactly what is written here. So beg your pardon, this will be gain, and this is what is written here, and therefore that tells me that overall my accounts are prepared in a correct manner. So the net CFI is down by 40,000. Okay. Let us also see if we were to make the same thing by the net basis. So that tells me that I'm going to make only one account, which is gross less the accumulated depreciation, and I have pluses on this side and minuses on this side. My opening value was 100,000 minus 40, now coming at 60,000. My closing balance is 75. Now point to be noted is, since there is only one single account being prepared, all the adjustments related to the depreciation or sale will come in one single account. What I'm trying to highlight is that when the accounts are made on the gross basis, there is no adjustment for depreciation in the gross value, because the gross is really before depreciation. If at all there is any depreciation, that will come in a separate account. But now, since there is only one account to be prepared, every entry will appear in one single account. So we got to be very careful to write everything in one single account, which is 60,000 is the opening value. How much is the depreciation during the year? 29,000. And the sale of asset, which I know the written down value of which is 21. So now earlier you would see that I had deducted 45, which is at the gross value. Now I'm going to deduct only 21, which is the written down value. Again, because of to create apple to apple, 45,000 was commensurate with this 100,000. Both were at the gross value, but this 21,000 is commensurate with the 60,000, which is both at net book value, which is the written down value. So there is still a balancing figure on this side. My total is 125, and the balancing figure that will come here is, you will be surprised to see, is the same machinery purchased as before. So the point I'm trying to drive home is that the answers will not be different if we prepare the accounts by the gross value or the net value. It is just that preparing it by the gross value seems a bit easy because there are two different ledgers, different balancing figures. Things are very simple. Whereas in case of net value, every entry comes in one single account related to debt and related to purchase and sale, etc. Sometimes becomes a little confusing. So to summarize the session, let me just end it by mentioning two key points. One, when the accounts are maintained on gross basis, the entries for depreciation do not come on the gross value, and any sale is mentioned at the original historical cost. In case, my point number two is, whenever we prepare your accounts on the net value basis, any sale entry also comes at the WDV on the date of sale. Now these are some of the fundamentals that we are going to talk about in long-lived assets also, but I think that's pretty much simple and easy to understand. So I hope this session was useful. It was a very interesting session, and I hope the confusion is sorted out. Doesn't matter you prepare the accounts by net or gross, answer remains same, so therefore should not be a much of a problem. Should you have any further query, questions that you need to for us to take up, we will be absolutely happy. Should you write to us at finstudyclub@gmail.com. This was Ankur Kulshrestha. Look forward to speak to you in my forthcoming sessions. Thank you very much.